Hi there, welcome to Market Call. I always particularly enjoy these shows because we focus on a specific sector. Andrew Moffs is our guest. He's Senior VP and Portfolio Manager at Vision Capital. He's taking your questions on real estate stocks and REITs. You can call us toll free, 1-855-326-6266, or send an email to marketcall@bnnbloomberg.ca. Andrew, great to see you. Thank you very much for joining us.
Thanks for having me on, as always.
It's been tough this year for real estate stocks to generalize, partly because interest rates just have not come down.
Yeah, I mean, there's no shortage of negative headlines if you want to find them on commercial real estate. The easy ones are office, and that was happening prior to the pandemic. When you have capital expenditures rising faster than rents, that's bound to happen. And then the pandemic changed how we all use office space. But the other headlines typically revolve around transactions that occurred in a different rate environment and how they're being worked out today. The reality on the ground of real estate fundamentals in some sectors, think data centers, industrial, are quite strong. And with interest rates now peaking, you're starting to see more bidders come to the table. You're starting to see construction activity go down and financing becoming more available. Notwithstanding rates are higher than where they were, they're in line with where they were with historic averages. So we're quite optimistic about real estate transactions occurring in the private markets. Mm-hmm. We're definitely bullish on the valuations of publicly traded real estate.
You know that Blackstone, who are some pretty smart cookies, they've already announced the privatization deals for Tricon Residential, listed on the TSX, and also Apartment Income REIT. So they see value here.
They do. They've been quite open about it. I mean, even yesterday, John Gray of Blackstone said they have $64 billion of dry powder ready to invest in real estate. And it's real. They've now privatized 2 real estate entities, like you mentioned, in the past 6 months. One of them was Tricon Residential at a 30% premium that, as we've talked about in the past, was positioned in our portfolio. They see the private markets as either fully valued, but the public markets as being on sale, and the opportunity to put large amounts of capital to work in a very quick time frame and the ability to finance it in a quick time frame is what is so appealing for private buyers today looking at publicly traded real estate.
Would you say we'll see more bids to take REITs and real estate stocks private?
Yeah, I've been doing this a long time, so I like to say I've seen a few movies. Anytime you see interest rates peak, fundamentals bottom, is the right time to be buying. So I think when sentiment is at its most negative, and this is something that Blackstone said, is typically the right time to be stepping into the market. We saw this happen in the period of time after the 01-02 recession. We saw this happen in the Great Financial Crisis. We saw this happen in March 2020 when values dislocate. Meanwhile, real estate becomes such a great store of value. People look at it as inflation, as a great inflation hedge, and it's a great opportunity to be buying.
Interestingly as well, I know we'll get into this later in the show, but there have been signs of weakness in these warehouse REITs, the industrial REITs as well. They were market darlings for a while.
Indeed. We saw such great absorption, meaning the amount of space taken up versus the amount of space, square footage, being given back to the market throughout COVID. It was almost as if third-party logistics companies thought that they could just supply patio furniture forever. But the reality is, I look at Green Street as a third-party provider. They'll tell you that industrial real estate is down 17% from peak pricing. Well, I look at the public markets and industrial REITs are down 30 to 40%. So they've really over-discounted what is just a temporary slowdown in decision-making by tenants. But when you cannot defer that decision for too long, you eventually have to make a leasing decision. And the spread between in-place rents and market rents is quite wide, meaning notwithstanding market rent growth doesn't go higher from here, you still have the ability to capture a lot of cash flow.
Andrew, it's great having you here. Thank you very much indeed. Andrew Moffs is our guest today on Market Call, Senior VP and Portfolio Manager at Vision Capital. And he is taking your questions on real estate stocks and REITs. 1-855-326-6266. Thanks very much for watching, and we'll be back. You're going to learn a lot about real estate. We have an email to kick us off from Glenn. Glenn is curious about Smart Centres REIT SRU. What are your thoughts on this retail play?
Yeah, so Smart Centres owns a portfolio of open air shopping centers across Canada, typically anchored by Walmart. What is great about having a tenant like Walmart is the cash flow is very, very dependable, and hence the cash flow of the REIT is very dependable. It has a higher distribution yield, Smart REIT, probably around 8% today. That said, given it's so defensive, you don't have a lot of internal growth. And when you look at Smart REIT versus some of its peers today, the internal growth really lags. And when you combine that top line internal growth, call it 1 to 2%, versus a very high interest rate headwind. They have higher leverage than their peers and higher refinancing to do over the next couple of years. You're going to see muted earnings growth. So I always say this is a defensive name. One can own if you just want the yield, but from a intrinsic value increasing perspective, it's not necessarily happening because the bottom line cash flow is not increasing.
That's interesting. So a yield just north of 8% right now on Smart Centre. So is one you own, is the dividend secure by your analysis?
The dividend is certainly secure, though by some metrics, they were over distributing a couple of quarters ago. They now have that below 100%.
Okay. In that vein, we have an email from Jacob. Jacob is asking about REITs with high yields. Are there any with big yields that could have share price appreciation over 5 years?
Yeah, so that's an interesting question. So in contrast to Smart REIT, where you would get that high distribution yield today, I would definitely look at a name like Sienna Senior Living. Ticker is SIA. Oh, okay. It's not a REIT, it's a corp. They own both retirement residences as well as long-term care residences. The yield is in around the 6.6% range. But when you talk about growth over the next 5 years, this is a name that's squarely within that definition. Again, they probably own about 42 long-term care facilities, 40 retirement homes. So nicely, there's a nice bifurcation between long-term care being more stable, 97% occupied, versus retirement homes that today are about 86% occupied, but Sienna has given themselves a goal of getting to 95%. You do that, and you have high single-digit internal growth over the next several years. This could be a really interesting stock. So this is a name we own in the fund, and we continue to recommend for those looking for a nice blend between growth and yield.
Right. I'm showing a yield of about 6.7% on that one. Peter is on the line from Vancouver. Go ahead, Peter, please.
Thank you. Great show.
Thank you.
Great host, Andy, and great guest, Andy Moffs, the REIT guru. Please, may I have your expert opinion on Minto Apartment? Thank you very much.
Thank you.
Yeah, Minto Apartment REIT is an owner of apartments in Canada, I think Ontario, Quebec, and out west in British Columbia and into Alberta. Went public several years ago, probably trades below the IPO price today, not because of any missteps that they have done necessarily, but more, the vagaries of the market. And, looking at this name, it trades at quite a discount to net asset value, so it's attractive on that aspect. Lower yield, which you would expect from an apartment REIT in about the 3.5% range. What I like is that they've always had strong management. They now have an internal CEO, as this company was sponsored by Minto, its parent company, when it went public. And they are on a path to look to grow the bottom line and they've fixed their balance sheet. They had some higher variable rate than others, And I think they're on a good path today. Operating in the apartment sector in Canada comes with some political risk in terms of the markets that one operates in Ontario, Quebec, and British Columbia, for example, that have rent controls. Mm-hmm. So in terms of risk, you never know if one day, you have a change in government perspective that could implement more restrictive rent controls. But for now, that is not a risk on the horizon. And so, I'd feel comfortable owning this stock.
Okay, let's head to Markham, Ontario. Anita, go ahead, please.
Good afternoon, gentlemen. Thank you so much for taking my call.
Sure.
My question is on CT REIT. I was wondering what your opinion is on this REIT. It neither has good dividend deal nor good growth. Your thoughts on this, please? I'll hang up and listen to you. Thank you.
CT REIT, the Canadian Tire entity.
That's right. So a very stable entity. At certain points in the market, we call these net lease companies. They're either in favor or out of favor, depending on what your view is on interest rates. The ability that you can, hold on to, in this case, a 6.8% distribution yield, and feel pretty good sleeping at night, knowing that you have an investment grade tenant really backing all of the rents. The stock does trade at a discount to net asset value. If you look at the chart today, you can see it's come off relative to where it had traded previously. It's a portfolio with a 99% occupancy level. So not a lot of upside in terms of growth. The growth comes externally, whether it be from acquisitions from the parent company or new developments. All that said, it's a very stable company, and notwithstanding how stable it is, they were able to generate 3% same property NOI growth, which for me is a good benchmark and a pretty good level. So if this is a name that you own, I would continue to own it. I see no current risks.
Let's head to Vancouver. Andre, go ahead, please.
Good morning.
Good morning.
I would like your opinions on H&R REIT. I bought it at about $13 and it has been going down since. I just wonder, should I sell, buy some more for average down or hold?
Okay,
thank you.
Very much, H&R REIT.
Yeah, so H&R REIT, what's always been difficult for a name like H&R is that they own great properties, yet being a diversified REIT, they don't get a great valuation from the market. So what do I mean? They own apartment buildings in the Sun Belt in the United States, a great portfolio operating under the Landmark brand. That said, that portfolio is facing a lot of headwinds today in terms of demand and supply in states like Texas, where you have a lot of new construction at a time where demand cannot keep up. They own, they continue to own some office buildings here in Canada. They have a path in order to work through them. They have a bit of a density pipeline as well that they're looking to monetize. They have some retail investments, et cetera. So they're going through a bit of transformation where they're going to just focus on multifamily and industrial, which I think is a really good strategy. It's just a matter of time. We talked about at the outset of the show, transactions occurring, just starting to pick up. Perhaps there's more bidders than there were 6 months ago. So if H&R is now going through this process of rationalizing their portfolio, hopefully it can happen sooner than later. But in the meantime, you have to sit tight and continue to own a name that has a secure yield, but perhaps will not have any definitive earnings growth for the next little while. Once you get to the other end, this will be a great entity to own. But I think in the meantime, there are some better opportunities out there. It just depends on your time horizon and your return thresholds.
Okay, and I'm showing a yield of about 6.7% for H&R right now. Is that secure, would you say, Andrew?
Yes, I do. I believe it is.
Okay. We're going to be back with Andrew Moffs of Vision Capital. He is taking your questions on real estate stocks, including REITs. We'll be right back at 1-855-326-6266. We are talking real estate with Andrew Moffs. We have Renee on the line from St. Catharines, Ontario. Go ahead, please.
Hi, I'm just a first-time caller. I'd like to have your opinion on Slater Office REIT, SOT. Is there any upside?
Ouch. That's an ugly chart. Sorry, Andrew, go ahead.
Yeah, I think it is certainly a challenging stock to recommend. As I mentioned earlier, the office sector is a difficult sector, was a difficult sector. We're going through a period of time of secular change where we're all using less office space. People are coming into the office less and less. And Slate Office owns a portfolio, not necessarily trophy buildings, more perhaps suburban buildings in some key gateway markets like Chicago, Dublin, and Toronto, but are going to really struggle in order to maintain occupancy and really get through what is going to be a very difficult operating environment. So not one I can really recommend at this point.
In theory, the yield on Slate is about 20%, but there has been a dividend cut. Will they have to cut again, do you think?
I think it's been suspended. The distribution.
Sorry.
Yes.
Sorry, I was working off bad information there. Your understanding is that it's been suspended. Okay. You mentioned Chicago, and apparently they're just desperate to do something about empty office buildings in Chicago. They're offering massive incentives to turn them into hotels and other types of properties.
Correct. I mean, at the end of the day, it's going to be very challenging for office owners, depending on their capitalization, to maintain great assets in difficult markets. So Chicago, San Francisco, downtown areas where you've seen heightened levels of crime and higher vacancies and less traffic in terms of people walking around, going to work, it becomes very difficult to maintain your buildings. And then you go through the spiral where you have lower property taxes to sustain things like security and police, et cetera. So certainly challenging. Hopefully we can find some alternative uses for some of these office buildings in the future.
Renee, thanks for that question. Arthur in New Waterford, Nova Scotia. I went to school in the original Waterford. Go ahead, please.
Good afternoon, gentlemen. I'd just like to get your guest's opinion on Killam Property and what he recommended at this price. Thank you.
Is that Killam Apartment REIT?
Yes, correct.
Oh, okay, you got it. Thanks very much.
Killam trades at probably about a 20% discount to the street's NAV, probably even wider to its own IFRS net asset value calculation. This is a very good portfolio. Its origins being in the Maritimes and since coming from Eastern Canada out west through the country. Certainly a name I feel comfortable owning. At the same time, you can find other opportunities to own apartment, residential in Canada, and we can talk about that a little later when we go through some of our top picks. But certainly a name, if you own, I'd continue to own it. I feel good about their portfolio.
Okay. We have John calling from London, Ontario. Go ahead, please.
Thanks, Andrew. If you're from, or if you know Waterford, I guess you know a thing or two about Crystal.
Oh, yes, that's right. Yeah, the famous Waterford glass. That's right.
Beautiful.
Yep.
Andrew M., thank you for Chartwell. Otherwise, REITs have been the ancient mariner, and interest rates, I guess, are the albatross. I bought Dream Residential REIT, and I'm wondering what you think of it now as compared with, say, Dream Industrial REIT. Thanks very much.
Okay.
Yeah, what we do at Vision, we focus entirely on supply and demand, and then go bottom up where we can invest within that universe. What sectors have compelling supply and demand, and then go bottom up where we can find the discounts. So what we're doing here is comparing multifamily apartment in the United States against industrial warehouse in Canada and Europe. The fundamentals in Canada and Europe and industrial are far superior today to multifamily fundamentals in the United States, particularly in the U.S. Sunbelt. Not because there's a demand problem in the U.S. Sunbelt, it's a new construction supply problem. You have peak deliveries coming on this year, and as I mentioned earlier, demand is not going to be able to keep up. So Dream Residential owns an older portfolio in some of the key Sunbelt markets across the United States. It trades at a very wide discount to net asset value, so that's attractive. It has very low liquidity, which certainly does not warrant any premium in this market. In contrast, Dream Industrial has really stellar internal growth prospects. They don't have to, even if they didn't do anything, they would see rents increase just given the big spread between in-place leases and market rents. And hence, if I were to pick between the two Dream entities, I would own industrial over residential today.
Even though there's been cooling, maybe we can put up a chart for Dream Industrial, even though investors have gone colder on warehouses?
Yeah, it's that second derivative concern of growth. It's not that industrial fundamentals aren't growing, meaning demand isn't growing. It's just that the rate of change is slowing. And so we feel pretty good about fundamentals. You look at vacancies across Canada are currently 2.7% in industrial. Even in the United States, they're called in the 6.5% range. That's still, certainly in Canada, it's a landlord's market. In the United States, it's more balanced. What really the market is concerned about is that it's taking tenants longer to make decisions. They still have to make decisions, but they are taking their time. But we fully believe that you will see absorption in the United States and in Canada continue to move higher, notwithstanding we have higher construction deliveries coming this year. We think new construction activity is going to fall off 50% at least going into next year.
Terry is in Edmonton. Go ahead, Terry, please.
Good day, gentlemen. My question is on Allied Properties. I own it, and it keeps going down. Do you ever see a turnaround with this company, and how's the price compared to net asset value? Thank you very much, sir.
Thank you.
Yeah, I go back to supply and demand, and this is quite challenging. You look at Allied, its key market is Toronto. I haven't seen this many times in my career where the downtown vacancy rate in Toronto is higher than the suburban vacancy rate. And that happened in the first quarter where downtown vacancies got to 17.2% versus the suburbs at 16.9%. That's that's the biggest change in direct vacancy in 3 decades. So that's the headwind that Allied faces managing office properties in Canada, particularly in Toronto. Specifically with Allied, they've muted earnings growth going forward. There's going to be limited organic growth. They have a higher debt load than what they previously had. Now that they've taken on a couple of new developments from their partner, Westbank. And if one were to include capitalized interest in G&A in their distribution stats, you'd find that perhaps they don't fully cover their distribution. So they have a lot of leasing they need to do, a lot of execution that needs to happen in a very difficult market. And so, if one wants to make that bet, there's quite a discount there. But that said, when you have this many headwinds and limited earnings growth, I think there's probably better opportunities elsewhere.
So you're not biting on Allied Properties at this stage?
Correct.
Okay. Trevor in Sierra Vista, Arizona. I want to get there someday. Trevor, go ahead, please.
Well, you're more than welcome, absolutely. My question today is on PSA, Public Storage REIT. This one I hold, and it's been sort of flat for quite a long time, and I'm wondering if their operations is okay and solid. And secondly, they bought Shurgard, which is a European public storage company, 20% of that company. Can you talk a little bit about that as well? Thank you.
Thank you.
Sure, happy to. So Public Storage is the original self-storage operator, really revolutionized the industry beginning 40 years ago, 50 years ago. Today, it's an enterprise, 50, 60 billion in size. They have become very sophisticated with age in terms of how to operate their portfolio using technology and being very smart in terms of how often and how much they can increase rents to sitting renters. The self-storage industry in the United States is having a bit of an indigestion. We saw rapid growth during COVID, a lot of demand. That has come off quite a bit. There was some new supply, and hence all the self-storage operators, not just public storage, are battling with rents rolling down as soon as a tenant leaves one of their facilities. Mm-hmm. Public storage has one of the best balance sheets you'll find in the entire REIT universe. It is extremely defensive and hence has done a good job navigating throughout a tougher environment. In terms of its acquisition of Shurgard, that was a U.S. entity they purchased 20 years ago that had a burgeoning European operation. They since spun off the European operation into a separate publicly traded company that is traded in Europe. European fundamentals are improving, and that's probably an entity one could do further work on and discover that it's trading at a discount to net asset value.
Trevor, thanks for the question. We are going to take a break. When we return, we'll take a look at Andrew's past picks. That's next on Market Call. Andrew was on our show March 30th of 2023. Now, it has been a tough period to own real estate stocks with interest rates staying high, concerns over office oversupply. Let's get to his ideas, though. First Capital REIT, FCR.UN. In this case, the distribution kept you on side.
Yeah, correct. This is a name we continue to own in our portfolio. It's actually one of the largest weights. What I love about this story, it's so resilient. You have a core portfolio of $7 billion of necessity-based real estate, 80% grocery anchored. That portfolio has internal growth of called 4% per annum. But then you have a further 24 million square feet density pipeline, of which only 7 million square feet is reflected on their balance sheet. So what does that mean? Over the next 3 years, probably another 6 million square feet will enter their balance sheet in terms of entitlements. That could add another $2 to the values. But even sitting here today, according to First Capital, their IFRS valuation of $22.10, you're sitting at a 35% discount to that net asset value. You've got a near 6% yield, so you're getting paid to wait. Well, the net asset value will only increase over the next couple of years, and they're on a great pathway in terms of both reducing leverage as well as watching earnings grow. So it's certainly a great name to own in this type of environment.
First Industrial Realty Trust. This one's in America, FR in New York. Just remind us, what are they about warehouses and stuff?
Correct. Yeah, I think I stole a bit of my thunder earlier in terms of talking about how strong industrial warehouse fundamentals have been, yet there's been recent weakness. And the recent weakness was simply that there was new supply, rising sublease space, and that was some of those third-party logistics companies that took on too much space during the pandemic, as well as some slower leasing decisions that pushed vacancy higher just across the U.S. market. But we're only talking about vacancies going up 40, 50 basis points to just around 6.2% right now. First Industrial has more than priced this in. This is one of the best portfolios sitting on the public markets to own pure play U.S. real estate. They only operate in about 15 markets across the United States. Its stock trades at a 27% discount to net asset value. The company's still able to generate 40 to 50% leasing spreads. So every time a lease comes up for renewal, they see their cash flows go higher by 40 to 50%. And so that translates to 7 to 9% internal growth over the next 3 years. So we think this is a great company to own. It's going through, as the market is trying to digest what, they're reading as negative news in the industrial space. We actually see a lot of silver linings here and think it's the right time to be investing.
And then finally, Dream Industrial REIT. We talked about this one already. I forgot that it was a past pick. I'm sorry about that. You do see value here, Andrew, though, still?
Yeah, I think there's a great setup here. same thing. They have a over 30% mark to market in terms of their rents. So if we never see market rent growth, they're still going to capture that upside just based between the spread today of what market rents are. And, book value is near $17. So you got near 25% discounts in the NAV. We actually think NAV is higher than their book value. And you have mid-single digit growth in 2024 and probably again next year. I think Europe is a great story. They focus in the Netherlands and Germany. And I think there's the logistics markets there are really starting to thrive in terms of e-commerce really changing the whole supply chain over there. So Dream Industrial is a great portfolio and trading at a wide discount to net asset value. So I think it's pretty compelling.
We got to take a break. Andrew Moffs is here from Vision Capital. He's taking your questions on real estate stocks and REITs. Doug is on the line from London, Ontario. Go ahead, Doug, please.
Yes, I'd like your thoughts on European residential REIT. It hasn't really been doing much in the last 6 months or so, kind of staying flat, but it pays a good dividend. So I'd like to know if you think there's any growth potential in this, and is the dividend safe? Thank you.
Thank you.
European Residential REIT owns a portfolio of housing units in the Netherlands. About, I'd say, 2/3 of its portfolio is more multifamily. 1/3 of the portfolio is more townhome style. It is an entity that's controlled by Canadian Apartment REIT, CAP REIT. Last year, ERE, European Residential, announced they were going to go through a process of strategic alternatives to try and unlock value. We think this is a very compelling entity in terms of the intrinsic value not being recognized in the public markets. The board agrees, and they went through a process. They weren't satisfied with the offers that were presented to them in the fall of last year, but the board still remains open to strategic opportunities. I think we're going into an environment where transactions can occur. In the meantime, European Residential is selling off individual units to residents. I talk a lot about net asset value, and that's what's so great about real estate is the intrinsic value is real. We can talk all we want about cap rates and what's the yield of the asset, but at the end of the day, if someone wants to buy your unit, there's a true value in the market, and that's what ERE is taking advantage of. So they're actually selling individual suites at a premium to where they hold these on their balance sheet. We'd love to see the ability for ERE to sell many suites in bulk, and I think that market is going to happen. So I'm not necessarily looking for earnings growth here. I'm looking for a value realization, and I think we're getting closer to that. The more interest rates have stabilized and the more transaction activity picks up, you could see something strategic eventually happen with this entity, as it's really too small in the public markets to continue to exist in its current form.
So you wouldn't be a buyer then, or would you anticipate, a privatization?
I'd continue to own the units, anticipating that the company could be sold.
Okay, sorry, that's you stressed that. Sorry, Doug. Thank you for that question. That's an intriguing story. All right, Paul in Calgary, go ahead, please.
Oh yes, I've owned Alaris Equity Partners Income Trust for years, but given that their price-earnings ratio of 4 is among the lowest in the industry, despite strong revenue growth for the firm for the last 3 years. Do you think it's a hold, a buy, or a sell, please?
Yeah, I wish I could help you on this, but unfortunately, Alaris Equity Partners is not a real estate entity, so taking my opinion wouldn't be too helpful.
Okay, we'll move on. Sunny in Mississauga, Ontario. Go ahead, please.
Hello?
Go ahead, Sonny. What's your question?
Hi there. Thanks for taking my call.
Pleasure.
I wanted to ask you about Northwest Healthcare. They seem to be in a penalty box, but I think the industry they're in, they're resilient as far as other groups are concerned from a real estate perspective. What are your thoughts? And is their distribution safe? Thank you.
Yeah, I mean, there's a lot of moving parts to this entity. You're right, the sector that they operated in, the healthcare sector, and specifically in their case, medical office buildings and hospitals, should be more of a resilient sector. They operate in multi-jurisdictions, Brazil, United States, United Kingdom, Australia, New Zealand, and other markets in Europe as well as Canada. You're dealing with multiple currencies, multiple credit risks. And the reality is this company capitalized themselves inappropriately in the sense of they weren't matching currency in terms of liabilities and assets, and they had too much debt. They've since now changed management, both completely in the C-suite, and they're trying to go through a bit of a strategic process, hopefully bring in partners or sell assets outright. The net results of all of that might be that it might be challenging to maintain the current distribution yield. I just can't, it's hard for one to quantify when you don't know what the results will be of a strategic process. So high risk, possibly high return in terms of owning a name like this. I think you're better off elsewhere. I'm more in the camp of superior risk-adjusted returns than trying to make a bet on something I can't control.
Okay, and they did last fall cut their distribution by more than half. We are going to be back with Andrew Moffs, and he's talking real estate. 1-855-326-6266. Bill is on the line from Uxbridge, Ontario. Go ahead, Bill.
Thank you for taking my call. I'd like your guest's thoughts on Main Street equity. It's had a rough couple of months. Does he see more upside, and does he hold it? Thank you.
Thank you.
Yes, we hold Main Street equity. They operate an apartment portfolio in Alberta, British Columbia, Saskatchewan, and Manitoba. The majority being in Alberta, about 56%, BC 22%, Saskatchewan 20%, and the balance in Manitoba. This stock has done really well. That's what that chart tells you, and it's what's been incredible about Main Street is the growth of the entity without having to raise equity, in contrast to REITs that pay out all their cash flow. Main Street is a corporation, so is able to hold on to their cash flow and reinvest and buy new properties. I do believe there's still a lot of upside here. The company estimates itself that net operating income could grow over 40% if rents are just simply increased to market levels. And we certainly think that's achievable. They typically buy assets that they put into their value chain where they reinvest in them and are then able to increase the rents. And they're certainly into that cycle and able to generate superior income coming out of it. So I think there's still a lot of upside to Main Street, and it's a name we continue on the portfolio.
Thanks for that question, Bill. We have Lee in Edmonton. Go ahead, please.
Yeah, good morning. Hi, Andrew. Could you give your recommendation on best of breed selection in companies that house the internet, which I think has a long runway? Companies such as Equinix and Digital Realty. Thank you.
Sure. Yeah, happy to talk through the data center space. It's a sector we're quite bullish on at Vision. Demand and supply is not in equilibrium. Demand is really outpacing supply for the first time in years. So demand is accelerating at a time where artificial intelligence deployments have only just begun. Hyperscale tenants, so think Amazon, Google, Microsoft, Oracle, they are really taking down whatever space they can ahead of these deployments. So when you need equipment, when you need power, and you need data centers to house all this, that's a good thing for companies like Equinix and Digital Realty Trust. So I'll just focus my comments right now on Equinix. This is one of the largest REITs in the United States and globally, a market cap probably around $70 billion today. We'll have about 10% earnings growth next year, trades multiple, certainly we'll portray that. It trades probably 25, 30 times, but it has such an interesting runway for growth. This is a name that we have owned at certain times. We don't own currently. We do own one of its peers, Digital Realty Trust. I'll be talking about that one shortly.
Okay. In fact, right on cue, we're going to get Andrew's top picks coming up next on Market Call. Join us tomorrow on Market Call. We're in for another treat. Rick Rule will be on the show, President and CEO of Rule Investment Media, and he'll take your questions on natural resource stocks. Oh yeah, don't forget, if you missed an episode of Market Call, subscribe to our daily podcast. It's available on iHeartRadio, Spotify, and your favorite places to get podcasts. First idea, Boardwalk REIT, the Alberta landlord.
Yeah, Boardwalk REIT is a name we've owned in the portfolio for quite some time, and it just continues to execute in terms of their operational capabilities, and yet the valuation remains compelling. So Boardwalk REIT, 2/3 of its portfolio is in Alberta. Alberta is a growing province in Canada, saw population increase over 4% last year, which is the highest of any province and the highest growth rate for Alberta since 1981. So people are moving to Alberta. They're looking for affordable places to live. Boardwalk provides that. Secondly, not just Alberta, but Saskatchewan. Alberta and Saskatchewan combined, those two provinces do not have rent controls. And those two provinces account for 74% of Boardwalk's cash flow. That is compelling because they're able to sign new leases at 10 to 15% increases. They're able to push out renewals at about 7 to 9%. And cumulatively, that combined with occupancy, you're seeing, they say they're going to generate anywhere between 11 and 14% internal growth this year. So the earnings trajectory is strong. Then we look at valuation. And this is where I just keep it simple. The stock, if you look at it trading today at around $70, implies you can buy Boardwalk at $200,000 per apartment suite. I challenge anyone to build apartments at $200,000 a suite. In fact, we see apartments trading at $270,000 a suite for older vintage product that may not even be comparable to Boardwalk, but at that level, the stock would be north of $110. So we think their own IFRS values of $90 are conservative. In the meantime, we don't have to worry about the transaction market. We can just watch cash flow go higher and net asset value increase.
So how much does it cost? I know it's really hard to generalize, but how much should it cost to build an apartment, Andrew? I know there's all these costs you got to take into account.
I mean, you're seeing new builds trade north of $300,000 a suite. But again, it all depends if it's stick frame or concrete high rise, and then that's not even including the cost of land. So it really all depends, but really at those levels you can't replicate what Boardwalk has.
Okay, Digital Realty Trust, and remind us what they're all about.
Yeah, so this is the second largest data center REIT globally. I touched on data centers in answering the Equinix question. Data center demand continues to accelerate. We saw record industry leasing of megawatts in the quarter, really 4 times as much leasing done in the quarter than a year ago. And then I look to the health of the tenants. You look at the big tech and their cloud business revenues. Those are up to about $65 billion, which is up over nearly 20% year over year. That's between Amazon, Google, Microsoft, and Alibaba. That means they have a lot of capital to put towards data centers and deploying their cloud rollout, as well as the coming AI boom. So, Digital Realty Trust, they own, call it 300 data centers, 2/3 of which in the United States. Great presence globally, and they house the majority of where this activity is happening, and they have pricing power for the first time in many years. So we see, per annum, over 5% internal growth, and that could even be higher. That's pretty conservative because it really doesn't give much credit to the AI boom that is potentially coming. So a stock that trades at a modest premium to net asset value, but net asset value is going to compound and increase over many years.
And then finally, Chartwell Retirement Residences. What's the attraction here?
So private pay focused, upscale to mid-market retirement homes across Canada, a premier operator. This one also I kind of say is pretty easy in terms of the demographic wave. If you look at the 80-plus year cohort in Canada, it's going to grow 4.3% over the next 20 years per year. So you have demand growth of over 4%. You have limited new supply, call it 1%. At a time where there's already a deficit of housing in Canada. Occupancies at Chartwell are around 86%. They're on a path to 95% occupancy by the end of next year. They did just to give you a sense, they did 640 basis points of growth in the first quarter. And every point in occupancy is over $8 million of revenue. So there's a great path here to increase net asset value and own a great platform in what is a compelling supply and demand backdrop.
A lot of capital is not going into building senior housing or retirement residences?
Thankfully, we're past that wave. We've always had this demand boom coming, and so people were anticipating that, and new construction was high going into the pandemic. We've now churned through a lot of that new supply, and now the demand and supply favors the landlord today.
Thank you very much, Andrew.